When it comes to passive investing, two of the most popular choices are index funds and ETFs. Both are simple, low-cost ways to grow your money over time, and both are loved by beginners and experts alike. But if you're wondering which one grows your money faster, and more importantly, which one is right for you, this video will break it all down. By the end, you'll have a clear understanding of index funds, ETFs, how they work, the differences between them, and some examples to show you what kind of returns you might expect. Let's start by explaining what an index fund actually is. An index fund is a type of mutual fund that tries to copy the performance of a specific stock market index. For example, the S&P 500 index tracks 500 of the largest companies in the United States, like Apple, Microsoft, Amazon, and Coca-Cola. If you invest in an S&P 500 index fund, you own tiny pieces of all those companies at once. Instead of trying to pick winners, you're betting on the entire market. Over the last 50 years, the S&P 500 has returned around 10% annually on average, which means if you invested $10,000 back then and reinvested the dividends, today you'd be sitting on well over $1 million. That's the power of index investing. Now, what about ETFs? ETF stands for Exchange Traded Fund. An ETF is very similar to an index fund in that it can track the same exact indexes, like the S&P 500. In fact, one of the most popular ETFs, ticker symbol SPY, follows the S&P 500 too. The main difference is that ETFs trade on the stock exchange like individual stocks. That means you can buy and sell them during the day. Their price changes throughout market hours, and they can be more flexible for certain strategies. An index mutual fund, on the other hand, usually only trades once per day at the end of the market. So at their core, both index funds and ETFs often own the same types of investments and have very similar returns. If you buy an S&P 500 index fund and I buy an S&P 500 ETF, we'll both likely get around the same growth over time. But the question is, which one grows your money faster? To answer that, we need to look at the differences that actually impact your wealth. First, let's talk about fees. The amount you pay in fees directly affects how fast your money grows. Historically, index mutual funds sometimes charged higher fees, while ETFs were designed to be ultra-low cost. For example, Vanguard's S&P 500 ETF, known as VOO, charges only 0.03% in annual fees. That means if you have $10,000 invested, you're paying just $3 a year in fees. Compare that to some older index funds that charged 0.5% or more. Over decades, that difference adds up. If you invest $100,000 for 30 years, a fee of 0.5% could cost you over $100,000 in lost growth compared to an ETF. So in terms of fees, ETFs often give you a slight edge in growth. Second, we need to look at flexibility. ETFs let you buy and sell instantly during the day. If you want to invest $500 at 10 a.m., you can do that. If you want to sell at 2 p.m., you can. Index mutual funds, however, process transactions at the end of the trading day, so you don't have control over the exact price you get. For long-term investors, this difference might not matter much. But for someone who values control, ETFs are more flexible, and that flexibility can help you put money to work faster. Third, let's look at minimum investments. Many index mutual funds require a minimum starting investment, often $1,000, $3,000, or more. For example, Vanguard index funds used to require at least $3,000 to get started. ETFs, by contrast, can be bought for the price of just one share. And now, with fractional share investing, you can invest even $10 into an ETF. This means ETFs make it easier for small investors to get started right away, and the earlier you start, the faster compounding can work for you. So once again, ETFs may give a slight advantage in terms of how quickly your money begins to grow. But here's where index funds sometimes shine. For people who want pure set-it-and-forget-it investing, index mutual funds allow automatic contributions very easily. You can schedule a direct transfer from your bank every month, and the fund automatically invests it for you. Some ETFs don't allow that level of automation. You might need to log in and buy shares yourself unless your brokerage supports automatic ETF purchases. That extra automation makes it easier to stay consistent. and consistency is often more important than small differences in fees. For someone who struggles with discipline, an index fund might grow their money faster simply because it keeps them on track. Let's compare a real-life example. Imagine two friends, Alex and Maria. Alex invests $500 every month into an S&P 500 index mutual fund with a 0.05% expense ratio. Maria invests $500 every month into an S&P 500 ETF with a 0.03% expense ratio. After 20 years, assuming an 8% average return, Alex ends up with about $295,000, while Maria ends up with about $296,000. That's only a $1,000 difference over 2 decades, all because of the slightly lower fee. The lesson here is that both choices are excellent and will likely give very similar growth. So which grows your money faster overall? Technically, ETFs usually have the edge when it comes to fees and accessibility, which can slightly boost growth over the long term. But in practice, the difference is tiny compared to the impact of starting early, investing consistently, and leaving your money alone to compound. Whether you pick an index fund or an ETF, the key is to stick with it. One way to think about it is this. If investing is like planting a tree, the important part isn't whether you water it in the morning or afternoon. The important part is that you actually plant it, keep watering it, and give it time to grow. Both index funds and ETFs are seeds that can grow into big financial trees if you're patient. To wrap this up, index funds and ETFs are more similar than they're different. Both give you instant diversification, both are low cost, and both can make you wealthy if you stay invested long term. ETFs are slightly more flexible, often cheaper, and easier to buy in small amounts. Index funds can be more convenient for automatic investing and hands-off strategies. At the end of the day, whichever one helps you invest more consistently is the one that will grow your money faster. So the real answer isn't index funds or ETFs. It's you. Your discipline, your consistency, and your ability to let time work its magic will determine how much your money grows. Choose the one that feels easier for you to stick with, and then let compounding take care of the rest.